Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, as well as Chris Englebert, Founding Partner and CIO of Englebert Investment Advisors. We're here to discuss the psychology of investing and wealth creation. It is great to have the both of you with us, as always. Chris, one of our old-time guests who's been on with us since inception. That's why I'm glad that you want to discuss the psychology of investing, wealth management, the long-termism of it.
Right.
Because we've been through 8 years together. Things have changed.
Yes, absolutely. And Jill, so we've just seen a microcosm in the last month of incredible risk aversion when the tariffs came out. Market, dumped 21% by the S&P 500, and then we have Liberation Day, a 10% up day. Market rallies almost 24%. So you go from extreme risk aversion to this FOMO, fear of missing out. We're compressing the time frames, but investors are allowing themselves to be psychologically manipulated by what's happening with the news. We've had 1 to 2%, down days. We've had a 10% up day. And, I really attribute it to the fact that, like we were talking off camera, just flooding the news with so much information. Investors are like, what do I do? And we're seeing these extremes. And so, one of the other problems I really have out there, I call them the TikTok financial influencers. They're creating a scenario where, well, if you were in this particular stock, you're up 100% this year. Nobody puts all their money in one particular stock. They give a lot of investment advice that's really not appropriate, but they make it sound like everybody else is making money and you're not making money. You should be doing something different. If you look at where the averages are, bonds year to date are up about 2.5%. Equities, depending upon the index, are up 2.5%. There's individual stocks that have done really, really well. But again, the psychological impact of risk aversion, fear of missing out, everybody's making more money than I am, I think is really very detrimental to the investor.
Yeah, and Max, Chris makes a great point here because we're up 2.32% on the year. Sounds like we're flat-ish, right? Nothing's going on. Well, if you look at it, over the past 6 months, there's a lot going on, and it's just concerning when when things become very complacent. And it's not just equities. You see it in areas of fixed income. You see it in areas of digital assets. We were just talking about the gold-silver ratio before, some other volatility indicators. There's a lot of things that are at inflection points or range-bound. And that's always like you're waiting for the shoe to drop.
The shoe to drop. We're seeing a lot of tight ranges. Now, tight ranges. We saw incredible volatility earlier in the year. We're talking about move index volatility in bonds, which never really move. And now it's kind of, okay, we might be flattish. There's been like you said, there's been so many events that have all happened in a short period of time. We're not even halfway through the year yet. We're still in mid-June right now. And we've had so many different headlines that have kind of whipsawed everybody that now, like you said, there's a bit of that complacency of, well, we sold off 20% and now we're back. So why am I going to sell? Even if there are legitimate reasons to do so, it's, well, I'm not going to do it because I'm not going to miss out. And that's when you start to see those kind of snap moves where everybody, okay, tail risks now, all right, we're hedged now. Everybody looks for the tail risk protection after the move has already started. It's very complacent. Everybody kind of gets on one side. It's almost like the dollar. Everybody is short the dollar now. Everybody has a consensus trade. And then when that turns, it turns quickly. That's where we see the volatility. So it's an interesting time right now because we're kind of in a...
Well, nothing happens in June.
Right, nothing happens in June, but everything is happening still across the globe.
In macro, and
right.
That's what's moving.
There's a big focus.
Chris, is it fair to say, even talking only 20, 25 years ago, the composure of the market, the participants of the market, the amount of products that are available today, the markets are going to evolve and trading will as well?
Yeah, the problem is we have our cell phones. You can trade on your cell phones. I keep trying to tell clients that you really need to set a strategic game plan and figure out what you're trying to do. And this comes back to the fear of missing out trade. People like, wow, I only made 7-8% last year. And I'm like, do you understand that the compounding rate of making 7-8% is dramatic? And again, I've been in the financial services industry a long, long time. And I see this rush towards new products. Now, we have a couple of rules at our shop for creating wealth. And one of them is if it takes me more than a paragraph to explain it to you, you may not want to own it. So, I consider myself a pretty savvy investment advisor, and I have trouble understanding buffered notes, buffered ETFs, things like that. And I'm like, let's go back to the basics. Is it stocks, bonds, real estate? Really, what is it? Because the financial engineering, in the 80s and 90s was very rampant, but now I feel that it's gotten even, to the point where advisors have no idea really what they're putting their clients in. And to Max's point, when you have all of these potential inflection points, there's a period of time where when something breaks, it could break big. And so I hate to show how long I've been doing this, but back in the 1980s, there was the Putnam Option Income Fund. They would buy stocks and they'd write options against it, and it was supposed to be a real safe investment, generating 12 to 13%. Hundreds of millions of dollars went into that. We then had Black Friday, investment markets go down 20-some%. The portfolio manager covered one side of the trade, laid on the other, basically locked in about a 20% loss in something that was supposed to be safe and, quote, guaranteed. So my fear is that we're layering all of these different investment products out there, and that when something does change, you would be like, wait a minute, why are we really in that product?
Yeah, Chris, that's what concerns me with this gamification of the market as well, almost like betting, what's going to be the next buy the dip. I mean, we saw that just before, like early January, February, it was almost like a gamification narrative that was going around. I don't care who you are, Buffett, anyone in the big names, timing the exact bottom and top, and if anyone tells you on social media that they did, they're lying.
Mm-hmm. They are.
Right.
It's almost impossible to do it.
But you're not going to miss the whole move.
Right. You kind of wait for the confirmation, but like you said, it's everybody else. You're kind of seeing everything, and the explosion of options trading is almost like parlays with betting. You kind of juice the odds. Hey, I can make 10% in a stock, but with options I can make 200%, 400%. And it's kind of the seeing everybody else doing it. You're seeing it on social media and reports of all this money being made. So it's, okay, I need to get involved with it. That works until it doesn't. I mean, I'm sure everybody's seen it on social media. Somebody said, oh, if you have $300,000, you can retire. You just sell options constantly, and it's great. That works until it doesn't work. You're short vol, you're selling vol, and then all of a sudden, vol spikes and you're wiped out. But it's that kind of slow burn picking up. I also think the past few years have, I don't want to say warped expectations, but we've had double-digit returns for a number of years in a row, where you get to think that that's the norm. 20% is kind of what I should be expecting. 20% return. If I'm not invested, I'm going to miss out on 20%. Where that's not the historical norm. It's abnormal to have those type of returns. That turns into the expectation. And like you said, if you're, 8%, well, that's not enough. I need to go more and more and more. You're kind of leaving yourself exposed on the back end if it goes the wrong way. And like we've seen, and it's been proven, again, correct this year, we're down 20%, we're in a bear market, and we just snap right back. So that psychology of, hey, I'm just going to hold on or buy more, buy the dip, that seemed to work. We haven't really had these prolonged drawdowns, but they will happen. Like they are built into the system that you will get those sort of drawdowns, and when they come, it's, are you prepared for it?
But that's good, though. You can also pick up shares in your 401k as an example at prices that helps to not accelerate the returns, but you will see, better returns for different periods of adding to the market.
Right, and you bring up a good point. We call it buckets of risk in our shop. And so, your 401k is a different bucket of risk. You're adding money to it all the time. We run through a software product. We're able to manage people's 401ks where we're not the advisor. We were dialing down the risk in April, and then, when the market, came down, our indicators got compressed, we were dialing back up the risk. Well, you should have a different bucket of risk. Like right now, it may sound boring, but short-term bank CDs as of this airing are over 4.25%, 0% risk. So again, managing your risk buckets, because one of the other rules that we have, or one of the other observations I made over the years, I just added this one last year, is that people are very good at buying investments. They're not very good at selling them. And so the hot investment of the day, be it one of the AI stocks or one of the quantum computing stocks, people are like, hey, I'm going to throw 10 grand in that or 20 grand, and I'm going to hang on to it forever because 10 years from now we all know it's going to go up 100x. Well, we end up seeing that in our shop where they come to us and go, yeah, I have this account and I did it, I started it during COVID or whenever, and it went from 10 grand up to 50 and now it's back to 10 grand. because they never sold is what they end up doing. And again, not that, we're constantly buying and selling in our shop, but you've got to assess where your risk level is, what type of strategy do you have, and is that particular investment still meeting your strategy?
Right, but I mean, institutional and professional traders, getting in is the easy part. Getting out is the hard part, and I think Chris makes an excellent point, Max, understanding what kind of investor you are and what your time frame is. For volatility in the market might be scary for someone like myself, but for someone who is, in and out of stocks within minutes, this could be a gift. So
yeah, absolutely.
It depends what trader or investor you are.
Time frame is everything. What your objectives are and how long you're willing to or expecting to be in, how long you're willing to be in. You get these moves in certain names that are 5, 6, 7 years worth of appreciation in a week. You might think it's going to continue to go up, but say, wait a second, like, just short term, let me take that out and then put it somewhere else. Now, if you're in it for a long term, other ones that are kind of slower moving, more value names, you might be okay sitting in there and not taking that big appreciation in the short term, but it's going to be slowly to grow. Like you said, volatility is great for short-term traders. We see it all the time. Stocks start to move. I'm getting calls from companies, hey, what's going on? It's like, well, it turns into a bit of a feeding frenzy. Volume picks up for one reason or another, volatility starts to pick up, and you just see the shares getting turned over, and it's great for short-term traders. They're in and out, making a quick buck, but they're not the long term. If you're in there long term, the volatility is scary because you're watching your Nasdaq potentially go down or up, but it's time frame is everything, and I think that gets missed a lot in terms of the investing, media landscape, especially on social media. Everything is short-term trades, but not everybody's a short-term trader and really shouldn't be.
Chris, out of curiosity, you work with a lot of local municipalities and pension funds and so forth. With the moves that we've seen, let's call it from Liberation Day to where we are now, and you have people that are dependent on the income from those funds, or they can't afford that capital drawdown, whether they're nearing retirement or in retirement. How do you manage that as an advisor?
Yeah, well, so in fact, we had a pension meeting last night, and so what ends up happening is with these large defined benefit plans, they have an actuarial assumption, 6.5%. That's the target they're trying to meet every year. They use a combination of stocks and bonds to try and get that. It'll be interesting to see if they meet that this year, because again, we're only up, low single digits right now. The pension funds take a long-term time frame. They have to. So the actuary last night in his presentation was talking about, we're looking at this pension fund over 30 years. Here's how the returns that we need to have. Now, the retirees that are getting the defined benefit pension, I don't want to say they don't care, but they are getting a certain amount of money every month. The one thing that we have to talk to them about is, what are you doing with your other assets? Because, if you're getting $4,000 or $5,000 or $6,000 a month, that's it. That's all you're getting. And if you're in your 60s, you could easily live into your mid-80s. Inflation is going to do a number on you. So we talked to them about their other assets, like, okay, that payment you're getting every month, that pension payment, that's like your bond portfolio. That's giving you income. You need to look at your other assets, and do we want to do dividend stocks, small, mid-cap, international? What do we want to do with the rest of your money to try and beat that inflation number? I really think, obviously there's a Fed meeting, and the Fed, we said this last time I was here, that I said the Fed is scared to death of a reignition of inflation. I really think that people are underestimating the embedded inflation, whether it comes from tariffs or something else, higher energy costs, higher food costs. We have now gone back to a higher inflationary period of time, and I don't think people are really paying attention. They were a couple of years ago when it jumped big in one year, but they were like, oh, inflation's come down, it's around the 2% range. Everything seems to be normal. I'm like, that's not how inflation works. Once you got inflation, you got it.
Well, see, part of the challenge with that is, too, the S&P 500 is up nearly 95% in the past 5 years, right? So if that's, back to your point, 7-8% is very, very good. But when you hear numbers like that over 5 years, you could see how investors might overlook the inflation issue, especially, when it comes to administrations, whether it's Trump or anyone else. Voters vote based on how the economy and the market are doing, perceived or otherwise. So you can understand why inflation might not have been at the forefront when you're seeing returns like this.
Right, and I think the other thing that we're struggling with this year, and again, this isn't a political comment either way, But we've had the tax bill, it's out there floating around, whether it gets passed or not. I think that's going to be very important. But we're also, I hate to say, experimenting with tariffs in this country. We've never experimented with tariffs. So do you raise people's tax rates? That's not a good idea. But now we have tariffs, which is kind of like a consumption tax to help offset the amount of spending that the government is still doing. And I've been saying to clients, it doesn't matter what your policies are, political persuasion. What you got to focus on is, okay, the tax cuts are good, but what about the spending? How are we getting that under control? And again, when I talk about the spending, I'm like, that's why I'm saying that inflation is embedded, because as long as we have high government spending, you're going to continue to have that embedded inflation.
And the Fed's in an impossible spot.
Yes,
because
they
if
are.
we don't get spending under control, that's not the Fed's mandate.
Exactly.
Hope everyone takes a lesson from this. Max, last words here. Anything that you're hearing from Nasdaq issuers on the desk as it relates to the environment?
I think it's quieting down at this point. We're kind of past that initial earning. The last wave of earnings were obviously better than kind of initially feared, but there still remains a large amount of uncertainty. Now we're in this kind of quiet period again. Buybacks are in that blackout period. I think the focus is going to be trying to get more clarity for the back half of the year to be able to actually issue guidance that they're comfortable with, that it's not going to change again in a few weeks. And that's kind of what they're focusing on is, okay, I'm trying to run my business. I need a runway of a year of what am I looking at to try to build my pipeline, take care of inventory, who my customers are going to be, what are they willing to spend, what's their environment. And when everybody has those question marks, it's really hard to run their business. So getting some of that clarity, again, it feels like the tariff issue is kind of, I don't want to say behind us, but now we have other headlines. That
Maybe we weren't thinking about talking about potentially entering a war.
Right. So there's new headlines now. Will that impact energy prices? Obviously, energy kind of powers the world. Hasn't really so far. We've kind of seen a bit of a fade of that move. That'll obviously be a key driver. If that escalates, tariffs, even this government spending bill, I feel like will very much go to the background. And if we really get a spike in oil, kind of all bets are off and expectations are really going to change.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.